Thanks for tuning in to today's podcast. Please remember that all of the information in this podcast episode is limited to general information only. That means the information is not specific to you, your needs, goals, or objectives, so you should seek the advice of a licensed and trusted financial professional before acting on the information. And before you acquire or apply for a financial product, please read the PDS or product disclosure statement, which should be available on the issuer's website. Lastly, please keep in mind that past performance is not indicative of future performance. This episode of the Australian Investors Podcast features Jamie Nemtsas, founder of the Inside Network and partner of Wattle Partners Financial Planning. Jamie and I met at the start of COVID in early 2020, after he reached out to me when the Rask business faced its biggest ever challenge. He and his partner Drew, who's been on the show before, were vital in supporting Rask and giving us a second chance at success. Since then, the Rask network has grown faster than I ever thought it would. Jamie's professional background is unlike any other I've come across. He grew up on a farm, growing fruit, and within a few years found himself running a financial planning firm at a young age. He then went on to take control of a very successful global events business, seeded an agricultural company that listed on the ASX, and most recently, through the Inside Network, Jamie established one of Australia's fastest growing events businesses, specialising in high quality investing and finance related events. Jamie and I talk about building businesses, selling businesses, managers versus directors, financial advice, IPOs, and what it takes to succeed in events, PR, and financial planning. I'm all but certain this will be the first conversation of many with Jamie Nemtsas of the Inside Network and Wattle Partners. Enjoy. Jamie, welcome to the podcast, mate.
Thanks, Alan. Pleasure.
It's always a pleasure to sit down and chat. This is going to be a bit of a different podcast because we're going to talk about your journey in financial planning, starting businesses, selling businesses, what makes a really good event. Your latest events conference business is taking off. But to set the scene for everyone, I know you grew up on a farm. How did you go from farm to being involved in finance?
Yeah, it's a good question. I suppose I always love farming. I say that I've got dirt running through my veins, and I grew up with a family of five. My dad was always a farmer by trade. It was a fruit salad farm, so we had lemons, apricots, wine grapes, dried fruit. And my brother was on the farm. I finished year 12 and did relatively well. And I said to Mum, okay, I'm ready to come home on the farm. She said, oh, actually, we're having a bit of a tough time. So why don't you go to university? And I thought, that's a fantastic idea. And I went to university with no real plans of having a career because my career was going to be back on the farm. I decided not to do agri, and I thought I'd watched a movie the week before applying and thought bankers dress really well and I wanted to be a banker. So okay. I did banking and finance at University of South Australia. So that was a 3 or 4 year course. It was close to where I grew up, which was Moorbeen, 3.5 hours. I could always travel home and see the family. Finished that course, went back to Mum and said, all right, I've finished my degree now. Can I come back? And she said, no, still not doing that well. So I came down to Melbourne where my wife, well, now wife, she was finishing her legal degree. And I came down late. So there was no real graduate positions available. And I found this job that was for financial planning. Now, I never really thought I wanted to do financial planning, lots of face-to-face people. I was more wanting to do merchant banking. So I took this job, a relatively well-known planner in Carlton, and that worked for a very big agency, top of the tables. And he had done some really interesting things, good and bad, through his career. But at a young age, he entrusted me to run his planning business. So I think I was 22, and wow. He gave me the opportunity to run his planning business, and he concentrated on selling real estate to his client base. So he had mainly a medical practitioner client base, and he got them through sales. So I learned a lot from this man in terms of how to sell. And he was a sales machine. Now, ethically and morally, maybe we didn't get along, but in terms of what it takes to build relationships and to sell to people, is a really interesting thing that I learned really early.
How did he market did he get that medical, client base?
Yeah, so he did. It's quite funny. He did pizza and beer nights at universities and at hospitals for graduates, and basically he always had a message. His message was, as a graduate in the medical industry, you've been to university for plus 30 years. So how are you going to protect yourself? So he sold, in the good old days, income protection insurance that paid 150% commission, and he also sold superannuation. So selling protect yourself and then make sure you've got money once you finish your career, and pizza and beer. So it's just like a perfect combo, really. And it's interesting that what that built, he did it year after year after year after year, is that you would get people that were 55 or 60 with a big lump sum that had trust for him because he did the right thing. They saw the right thing. They didn't see all the commissions, the right thing. So he had this great kind of pipeline of clients by just doing pizza and beer and giving some really good information to medical practitioners. And he was always, even though that everything was a sale, there was always a clear benefit for the other side. So he would, for a long period of time, and where we eventually had a falling out was he would sell property, but he would also sell the insurance for the property, and he would, make a clip on everything. And back then it wasn't disclosed. It's actually quite an interesting story. We finally fell out because he was selling some property not far from where I lived, and it was townhouses. 380,000 in Surrey Hills, 380,000 for townhouse. At that time, I thought, this is a total rip-off, and he was getting 4 or 6% commission that was undisclosed. And I said, your client, the client will never do. You're not putting the client first. I drive past those townhouses now, and they're worth $2.5 million, and everyone that invested into, including his 4 or 6% commission, has done incredibly well. So at that time, I was really young, wanted a professional career, didn't love the sales element of it, so I started reading. Today's version of podcast 25 years ago was to read, and I started reading a guy called Austin Donnelly, and Austin was really a critic of the financial planning industry, critic of the stockbroking industry, and wrote around 50 books. And I found there's a book called Sensible Share Investing, third issue, and I really enjoyed it. And I decided that was the type of firm I wanted to work for. So I found his firm, I called his firm, and they actually had an office about 800 metres from the office that I worked at.
Cool.
And I met a gentleman called Ian Murdoch. And Ian Murdoch was Austin's son-in-law. He ran a great wealth management business. And I asked him if I could go and work for him. And really, Ian is, I'd call him a mentor. He was a phenomenal person to work with. I then bought into that business, and I still run that business now. So that business was fee-for-service and independent. How the industry has changed 25 years later. And it initially, when I went in there, it was an hourly-based financial planning firm. So this is very early in this concept that financial planning was a profession, not a sales role, and it was hourly-based. Eventually, hourly-based didn't work because, if you're going to do research on what's a hot stock today, Zip. So if I sit down today with Zip and, I interview relevant people, run some numbers, build my spreadsheet, and then decide Zip is a fantastic buy, then I call you up and say, hey, Owen, I've got an idea. Why don't you buy some Zip? How do I charge you for that? Do I charge you 20 minutes that it took, or do I charge you an hour of the time, or do I charge you the full time? And then the next client I call up and say, hey, I've got an idea. It happens to be Zip. Do I charge them 20 minutes, but I charge you 8 hours? So that firm really progressed from, he had a great client base because he'd worked a long time at PwC, and he had lots of professional contacts. Austin had the distribution. He had the wide distribution, and then we eventually changed our fee structure to what it is today, and it's typically fixed fee. 3-year fixed fee at a set rate. So that was that.
You spoke to me previously and you said when you were younger, because this is still in your 20s, right?
Yep.
You spoke to me previously, and you had this goal of, you wanted to be successful, and you kind of had this idea in your mind that, and people who know of you or have met you know that you started or you took over an events business and that went well. What was driving you to go from financial planning then to step off and do that? Was there something that happened in that financial planning time of your life in that, I guess, period where you thought, maybe I can try something else as well? How did you get to that next step?
Yeah, as a financial planner, I haven't heard anyone speak about this. It's actually a very emotional business. So the emotion, 5 days a week, 10 hours a day can get to you. So that being, if you've got 150 clients, a lot of times clients will come in not agreeing. So husband and wife won't agree. They'll come into the financial planner and they'll ask your opinion. Now, whatever you say, a lot of time goes. I don't have that power at home. So, they're saying, what should we do, Jamie? Should we do this or should we do that? Typically, they haven't, and we'll talk about journey a little bit later. They've got off their journey. So they've either retired at, say, 55 and they don't have enough capital and, there's a dip in the market and they want to know what to do. So, and there's the old saying that, when markets go up, it's the market, and when portfolios go up, it's the market, and when the portfolio goes down, it's your advisor. So, there's a lot of, and I'd spent 10 years really building a business, and I was like, well, what else can I build? And there was a point in the GFC where everything was going pear-shaped, and we had bought the best research from a lot of groups about who to use and what stocks to buy, and everything was falling 70 or 80%. Some of the research companies were going belly up, and you're going, well, how do I have fiduciary obligations to my client? I'm using third parties to research, but they failed and disappeared, and I still get calls from Betty at 8 at night saying, Jamie, will my money be okay?
Yeah. So
I was probably on a search for a better answer, and Ian Murdoch's wife was Melda Donnelly, and Melda Donnelly had this business that kind of shared offices with us. It was separated, but we shared a kitchen. And Melda, if anyone that has ever met Melda will know that the quality of businesswoman she is, and she's been on, she was part of QIC and a number of superannuation funds, and she still is, and she's an exceptional businesswoman, and she ran a business called Centre for Invest Education. What they did is conferences for the pension fund industry only, and I had previewed it from afar, and then I decided to get involved in that business. Now, that business was very much dependent on Melda. Melda knew everyone. There was lots of key man risk. So to buy that business, there was a lot of risk. Of course, price always comes into it. A lot of risk, a lot of the price. So then I went on this journey of kind of sourcing education and knowledge. So I went from a wealth management industry into the institutional industry, and then we ran conferences across C-suite, which was left to right, so CIO, CEOs, chairs, and then we ran down through asset classes, so fixed income, equities, et cetera, et cetera, et cetera. And that was a great learning curve for me because we took the key man risk out, even though we couldn't replicate a Melda Donnelly, but then we added depth and research. So we hired 5 or 6 analysts that said, all right, we won't just be the conveyors of the conferences, we'll also be the thinkers. We'll make sure the agenda is cutting edge. We'll provide some ideas you haven't thought of before. And then we ran conferences all over the world, New York and Istanbul, and I got to meet, 5 or 6 Nobel Prize winners, and we heard really good and deep thinkers and built relationships, built networks. So, we have, let's say, friends and colleagues right around the world now. So it was a really important part of my journey. The business was always incredibly strong. So we would run an event and we would So on one side, there was thought leadership. On the other side, there was a need of fund managers and leading fund managers to meet everyone within the pension fund industry. You know, we talked about it and still do as fish and sharks, you know. So, you know, the fish come to feed on really good information and peers and networking, as sharks want to build the relationships to sell a mandate, all in an environment of thought leadership. So we were able to do that in a really smart way. We ended up selling that business to Euromoney, and the reason we sold it was we didn't quite understand the perpetual nature of that business. So people would come along and sponsor and participate, but the next step wasn't necessarily available, you know. So the next time I would talk with the head of marketing or the CEO was to sell the next event. So we weren't necessarily a part of something bigger. We were just the little bit. And we always thought the little bit would fall away. So someone came along, knocked on our door, offered us a multiple, and we went, yeah, okay, because we couldn't see how it was an essential part of the whole network. So,
whereas now you probably look at that and you think maybe that thinking was a mistake because it's still here today. People still need distribution. People still need to get that network with the funds. And do you feel that way? Like, do you regret selling it at all?
There's a long journey there. The sale didn't go that great. It ended up in a legal battle, you know. And I learned, you know, my life has been about learning, and you know, it learnt me lots of things. It taught me lots of things about myself, about dealing with big corporates on a sale, and what does that mean? Being passionate about something, but then wanting to sell that passion for a lump sum amount. So I don't regret anything. You know, sometimes
is what it is.
Different. You know, it's get up and go again and try to learn from your mistakes. And I think when I still love being a financial planner and still practice every day, but essentially I'm different than most financial planners. Most financial planners are grown up by being the admin assistant, paraplanner, then a financial planner. Their experiences outside the desk is very minimal, where mine is exceptional in terms of breadth and knowledge. You know, sold a conference business to the largest conference company in the world, able to grow that kind of fivefold. After that, I don't know if this is where you want to take the podcast, but I'm going to go there anyway. My the need for me to always do something in agriculture was really big. So my mum and dad still had their property, so I acquired that property, and then with a business partner, we grew that quite substantially. It went from $400,000 of turnover to nearly $90 million over a 5-year period.
Wow! How did you do that?
The industry was on its knees, so we were able to acquire dried fruit properties and wine properties and convert them into organic dried fruit, and then build a sales network around the world. And the sales network was built by just, you know, lots of shoe leather, knocking on doors saying, hey, we've got this exceptional product, we're from Australia. And the first sale globally was, we had this problem where we bought all these properties and we had so much dried fruit, the domestic market wasn't able to take organic dried fruit to the same scale we could produce it. So we had to go offshore. And then when we went offshore, we saw that there was a real need as well. So the industry had the right shape to it. And then we grew really quickly, and it was a capital-intensive business. We ended up listing on the ASX. Now I would say that was a mistake because we were told and convinced from lots of people that it was an EBITDA story. It was a profit story. But essentially, we were 4 to 5 years from being where we needed to be. And sure, it was an EBITDA story, but it wasn't the whole story. So therefore, when we listed, everyone expected a certain amount of profit, a certain amount of in an industry. You know, a lot of people say agriculture shouldn't be listed on the ASX because earnings are very hard to forecast. So we were probably 150 million short of the capital we needed to execute, and we didn't. We had the opportunity to raise that at float, but everyone's worried about the value of their shares and dilution and whatever. It was oversubscribed 7 times, and then and then it kind of lots of learnings there about when, and this is what I think I can provide to clients is, when do you take private money? When is pre-IPO appropriate? What is exit? And then lots of learnings around independent directors and what independent directors are and are different from what I thought directors are.
What did you think that they were?
I always think a board is there not for governance, but to help, especially growing businesses, roll up your sleeves, get involved. If you've got expertise or knowledge or relationships, provide that to your executive team. Where, post Enron, it was really 3 independents. Those independents stand off from everyone else, and essentially they're there for only governance reasons. But, good governance and being a good director are in conflict, I think, at the moment, and you see that a lot. And then there was a whole transaction, and we ended up, a long story, a major shareholder wanted to influence the outcome and decided there was a better management team than myself and my business partner pushed us out, and then we rolled that board, and another shareholder came over top. So good learnings, not a great outcome in terms of where that business is today. But again, would
it have been different if you hadn't listed?
Yeah, I think so. Yeah, totally. It was a private equity bid while we were listing, which was saying, they were saying we needed more capital. We didn't take that. One of the many mistakes, we didn't take the private equity. And then I just think the messaging, when you're really young, it wasn't that many years ago, I was a lot younger. And this kind of concept that you're going through a listing and, it's you'll be on the board and, you have your own code. It's really exciting. But, when we do it again, because I'm sure I'll be involved in public markets all my life, there's a whole different process. It probably should have had another $50 to $70 million worth of private capital into it before it was listed, and it probably needed to be diversified. So saying that, it's very hard to tell your corporate advisor or your stockbroker or anyone that's in that realm, because they're all vested. The broker is going to earn $3 or $4 million out of your float. Your independents all want $100,000 a year to be on your board. There's lots of people that won't tell you the truth because it's all vested, and essentially that's where we fell. Well, I fell in the trap. I thought everyone, kind of thought like me, and there was a common goal. So,
were you, just quickly, if we just backpedal just a little bit, when you started this business with your business partner, you still had the financial planning business. It almost seems like you've had 2 businesses at least on the go at any one time.
Yeah, very much so. We had 3. So wealth management, which my current now business partner Drew Meredith was a part of in wealth management. We had a bigger team, so that was fine. The conference business was in there, and also this Murray River Organics. So my mind could work across the 3. Lots of people were conflicted. But saying that, there's a lot of great business people in the world that have run multiple businesses. If you can run Apple and Pixar at the same time, you can run a drive-through business, a conference business, and a wealth business, I think.
But do you think it would have been different if you only had one focus?
No.
So if you were looking at a company and you were looking at the management team, would you give them credit for being on more than one board or running more than one business, or would you say that that's like a conflict?
I think so. There's 2 things. I think you always have to look at the depth of your team and the role that you're playing. In the wealth business at that time, I wasn't playing a real role. I was on the investment committee. I introduced some clients, but I had a team. In the agricultural business, I thought we created a very unique team. a very unconventional but a very unique team. You know, the organic farming is very unique to itself. You know, it's a totally different way to think about things. So I think you need to look at the quality of the team. When it comes to boards and multiple board positions, there is just some people that have exceptional ability to add value. And I think those people should be on multiple boards. There's other people that are just ticking, you know, post-professional career, ticking their independent director boxes and getting 5 or 6 pieces of remuneration. I don't rate them. You know, I think the good thinkers should have multiple roles.
How about for you personally? You know, this whole thing with the listed company not ending the way that you wanted it to. How did you take that personally?
Yeah, it's a you know, I think the trials and tribulations of business is really interesting. I didn't obviously upset me greatly. Being a business that we took from my family's business, my mum and dad's business, and then turning it into something. Why we created that in the first place, and why I was passionate about going back to Mildura. Mildura was in the middle of a drought, you know, lots of people unemployed, and it was kind of a view that if we could go back there and create a business that would employ people and help them pay their mortgages, it had to be a positive thing. And if we did that with a nice kind of green overlay of organic farming and taking farms, you know, vineyards, wine vineyards that were non-profitable, that were going to die off anyway, and convert them into something that was a bright spark for the Central Asia area, that was the real mission, you know. And I suppose the way that I've started thinking about that is what came out positively from that experience. And I think that paying a lot of people's mortgages or helping them pay their mortgages is a big thing. Relationships and, you know, pushing forward in an area where agriculture wasn't really growing and now it's growing. There's lots of positives to bring out of it, and just keep going. You know, surrounded by some really good people and friends, and, you know, able to go, all right, what's the next thing? And it's hard to give up something that you've started and listed. It probably shouldn't have been started or listed, you know. Probably shouldn't have been listed in the first place. Yep. People make that decision, you know, to be big or small. And
did you feel like you had to be big?
Probably the environment I was in, there was always, you know, it had to be bigger and better.
Yep.
And there was a critical point where we there was a piece of pie that we wanted that made us really, really important globally and domestically, and we chased that piece of pie. It happened to be, it's the biggest dried fruit farm, probably, it's definitely the biggest dried fruit farm in Australia. It could be one of the biggest in the world, and we needed that piece, and that's when we started to need external capital. So we got that on place, needed external capital. That was on a premise of pre-IPO, and then, you know, that's right when it kind of was like, wasn't better down. In hindsight, maybe it went a bit hard on, you know, some of the conversion techniques, but it's, you know, that. So I haven't answered your question, but, you know, you learn a lot about people, and not to be negative, there's a lot of people that you know, use everything they possibly can for their own interests and only their interests. So that probably taught me about being a bit more guarded and not trusting as many people as I used to.
Do you think
everyone?
Do you think that's more prevalent in public markets than private markets? So what I mean is that you've started quite a few, or ran quite a few private businesses, built significant wealth out of that. And you've also been, you know, involved in public markets, whether it's through financial planning, but also through your own means. Do you think it's easier? When I say easier, it's more transparent. You know people's incentives. You can have permanent capital in private markets, and therefore it makes life a bit easier for you?
Yeah, I don't know if my experience allows me to answer that totally. I think there's really smart ways to grow small businesses, and then there's a time to be listed. both in terms of your company's life cycle and also your life cycle. There's some good examples of great CEOs and great founders the second time around doing it really well. First time around they learned a lot, and it's kind of so I think private markets, public markets have got a place. Public markets, we'll talk about a bit later, but you can have really good management in a really poor stock, and you can have and not being and the market doesn't see that, and vice versa. You can have really, really poor management in a great stock, in terms of share price, and people still rate that. The ability to rank management from a third party's point of view, from a fund manager's point of view, I think it's incredibly, incredibly hard for them to do that. So,
I tend to agree, and I think that's the part that oftentimes people, and I know that this happens to be with private investors because they don't have access to management. I mean, we only get what's on the annual report, right? Or we see them in an interview every now and again. And how much can you really know about someone unless you've met them face to face to see how they operate with their colleagues or subordinates, right?
Yeah, even, you talk to a lot of these small cap managers and they'll say, hey, we do 300 company visits. Ooh, what's the definition of a company visit? And what do you see? You can make anything shiny if you shine it enough for people to come in and go, oh, okay, this is what we do. So the ability for a fund manager to really fundamentally understand what's under the hood is more than a company visit. Ushered into the boardroom, 25 minutes, some kind of promotional film. So, I don't think fund managers have that much more advantage than individual investors, like the people that subscribe to your podcast. And companies historically have been bad at telling the true story of what they do. You can just see the recent set of numbers that have come out in the Australian market for reporting. They don't necessarily tell you everything you need to know. It's supposed to be full disclosure. They'll highlight the positives and downplay the negatives. And, that's not what, as investors, we should be getting. We should be just being told the truth. They're not there in a sales role. They're there as basically the guardian of your wealth in a way, as a CEO or a chair, to tell us the good and the bad. And, don't worry about if the share price goes up tomorrow or down. Essentially, investors are normally in for the long term, and they want to know that there is issues with parts that are being addressed, and there's also positive areas. So I think there's still a lot of honest disclosure to go in the Australian market. I think globally there's a lot of it will change over time.
Let's talk about the next step, or more recent step for you, which was starting Inside Network. That's how I came to be involved with you, and I've learnt about what you do.
So post the conference business being sold and being in wealth management, so conference business being sold and then exiting the agriculture business, I had some time off, and then I went back to our wealth business. And then it was clear in that wealth management business there was a network that was needed, a network of like-minded advisors. The industry was changing. The Royal Commission hadn't happened, but it was about to. And I turned up to a number of events in wealth management, different to the events that I ran in the institutional market, and saw that we were being talked to or down to. A fund manager would pitch their views, or a company would be pitching their views. There was no really peer-to-peer interaction where I was talking to my other principals or colleagues, talking about how to construct portfolios, what is the best idea in here, how do you get the fee structures, and financial planners have been through the ringer. But, there's a tradition, a typical financial planner doing the right thing has got an enormous amount of obligations on them, both legally and, emotionally, but they don't earn a lot of money. Financial planners don't earn a lot of money. They've made a lot of billionaires. The Platinums and the Magellans are all made because financial planners support their product that, that they charge substantial fees for, 1.5%. No financial planner charges, 1.5%. So I think the idea that I was now back on the tools, providing financial planning advice, but there was still something missing. There was still this kind of network that I wanted to have with my peers of running the best financial planning firms that possibly we could run, and sharing ideas and views and being proud of where I started my career, which was as a financial planner. So what could I do to help that? And that kind of sprung. We were also in a period where we wanted to promote ourselves, and I started talking to PR firms about how do we get into financial review and how do we get more press. And one thing led to another, and there was availability to buy a PR firm. And, we thought that was a good idea to buy that PR firm.
Can you explain how the economics of a PR business works? Because I was new to this. So how, the PR business makes money, how you judge a good PR firm from a poor one.
So let's talk about traditional PR. Typically used by companies for their communication needs. So that could be internal communication, it could be external communication, and then their ability to get their message across. Now, before digital, before guys like you, it was a lot easier. It was judged on how many times you got in a financial review. So you would produce a press release, if it was with fund manager. You would send it out to your 130 contacts with the journalists. You would call each journalist and say, hey, this is a really interesting story, and this is why. Do you want to meet the CEO or the fund manager? And then suddenly it would be in the financial review, and that would be a tick for your PR firm to that company. You could then overlay that with advertising, and you could overlay that with paid articles, and you could overlay that with radio. So it's really, what is your content communication plan over the next 12 months, and how do you execute that, and then how do you measure that? Of course, now we're in digital. Well, the world has changed. So the old, and why we were able to buy a PR firm relatively cheap, is because PR has changed. And, PR is more about how do you get that message across. Financial review on a Tuesday is probably 8 or 10 pages, So how do you, and people are digesting content a lot differently than they did just 5 years ago. So we thought there was a great opportunity to go, all right, how do you solve the communication riddle of firms to their end user or their stakeholders by using traditional, but also multi-layering it? And then, so that's through digital, right? That's through making sure that you have a digital presence, that you're using podcasts, that, you're getting real feedback. Even if you're in the fin review and they print their 100,000 copies, how many people actually read that article and attribute it to yourself? Where digital, and you're a king of this, Owen, so you'll know, if you write an article and send it out to 100,000 people, you know exactly how many people have clicked. You actually know who's clicked. You know how long they've stayed. Have they forwarded it on? Have they revisited? That's all really powerful information, which, for some PR firms is confronting as well, because,
Totally.
if you go, only 200 people read that article and it cost you X amount. So and it's changing every day, every day. And we've seen that with the media rules just in the last week. Every day, digital PR and marketing changes. And I think it's a really exciting thing to be a part of. So we did that. And then when we bought it, we had a couple of publications, and we thought, well, let's push those publications out. So if we want to communicate to like-minded people, either as investors or advisors or the institutional market, let's do it through one-to-many formats. And that those one-to-many formats is publications.
Yeah.
So now we launched a business called Inside Network about 18 months ago, and it starts by communicating with newsletters, Inside Investor, Inside Advisor, and Investor Strategy News, which is talking to a specific audience.
So, yeah, right.
So
this was just before COVID, right?
Yeah.
And okay, and then this ties in with the events side of the business as well, right?
Yeah. So we think about helping a PR firm or a client of the PR firm, helping them get access to the right audience. So how do you get access to the right audience? First, you want to engage your audience. You want to give them really honest information. You want to give them ideas and tips and feedbacks. So you can do that in many formats. You can do it through publications, which you do as well. And you can do it through one-to-many, and then you can do it one-to-a-few. So really good events. And of course, the old business, CIE, ran the best events, I think, in the world. So this concept, you can do it through events, and then you can do it rather than one to a few, you can do it one to one.
Yeah.
So in terms of building these communities out of investors, like-minded investors, like-minded advisors, like-minded institutional investors, then it's got lots of elements to it. So are we broadcasting messages? Are we engaging in podcasts and video casts? Are we attending conferences? Because face-to-face is still the best format of building a relationship and building trust. And once you build a relationship and trust, it allows you not just to do business, but it allows you to take the information in a lot easier than if you don't have that trust.
That's one thing that I hear from a lot of fundies. They say to me, how can we get in front of this person? How can we get in front of that person? A lot of them just don't have a network, right? They just don't have the distribution or the means. And traditionally, the only way to get in front of so many advisors would be to go through the gatekeepers who provide research. And in the first 3 years, very few of those gatekeepers provide research or allow you to market yourself as a recommended product and so on and so forth. Because I know your business started, all of these businesses kind of came together just before COVID.
Yeah.
And that was pretty scary, right? I remember walking into this office on the first day and I was the only one in the office and you guys were all working from home. But then within 3 to 6 months, you managed to adapt to that environment. Can you explain how you did that?
I mean, there's some good learnings about being overconfident, and I was overconfident that a conference business, I've run them before, and I think conference businesses need to be big rather than small, and there's an enormous amount of small conference businesses out there. You need a very good events team, you need a very good content team, and then to execute an event, you need lots of people to do that. So we geared up with lots of people and had a plan across those 3 pools of capital to execute. And then, of course, COVID came along and wrecked that. We haven't retrenched anyone, so we've kept everyone that wanted to stay. What we needed to find, and it's a word that everyone's sick of, but we needed to find a pivot. We needed to say, well, how do we do this? Obviously, our publications were okay because they were digital. The PR firm was doing really well because people understood that they needed to communicate in a different way, but the physical events weren't available. So we was actually a guy that joined me in the Sydney office called Jason Darmody, and Jason Darmody is a phenomenal salesperson. He understands sales better than I've met, especially telephone sales, which is a skill that most people have left. And he came from the tech industry and in the UK, and he came back to Sydney. He wanted to live in Sydney, and we hired him. And he said, you've got to see this product called Meet the Boss. It's and what it is, 5 peers, either CEO level or investor level, and someone that's got an idea and someone that's selling them the idea, over-hosted or over-chaired by a chair. And at the time, he was talking about this product, and this is probably November 2019. He was talking about this product called Zoom. I was like, there's no way people will jump on a Zoom for an hour and be really open and honest. And I was nice to him. I said, it's a nice concept, Jason. We might think about launching it in last quarter of 2021, which is still not here yet. Because, some fund managers do want to get their message across. And so we pivoted to that, which has been phenomenal. So this, and it's a phenomenal product. It's called Inner Circles. We run it in the wholesale and the institutional market, where you get 5 financial planners, 5 to 6 financial planners or asset consultants or people on the investment committee together to talk about a specific issue, hosted by James Dunn, he typically is the host, and he makes sure everyone is included. So it's not a one-way conversation. It's like a two-way conversation. Everyone can ask anyone else a question, and it's using everyone's knowledge to leverage better outcomes for their clients. So it's been a really good product for us. We will keep that product now, or at service, or part of engaging. And then just all the usual stuff, lower your overheads, work really hard. My mum always said that, harder you work, I'm sure she stole it as well, harder you work, luckier you get. So we worked really hard. Everyone worked hard in our team to say we're a really new business, but we've got some new ideas and you can engage with people a different way. And that's similar to events. Events haven't really, in financial services, you will go to, that being the Australian Investors Association, Australian Shareholders Association of Switzerland, and you'll sit there and you'll listen. You won't necessarily be able to engage both ways. So if you can engage both ways, and the tech industry does it incredibly well. If you go to a tech conference, the engagement is both ways all day long. So we're looking to leverage off what the tech industry has done in events and conferences and bring it to the financial industry. I think we got off the topic again, but yeah. So
no, it's fascinating because we're going to host some events later this year, 2021, together, focusing on investing related content. And just hearing and speaking with your team, you get the sense that they've done it all before, right? Like they've been around the track a few times. What makes a good event for investors versus one that's not? You said one. Is it just that open dialogue back and forth, or what are some of the more creative things that you've done?
I think it's relationships. Like everyone wants to build a relationship. Either you're a buyer or a seller, but you still want to build a relationship. Yeah. And then you want to be able to take that information and think about how you can use it. So there's lots of information around, but are you going to include it in your portfolio? So if I'm a long short Aussie equity manager and I say, well, I've got the best product, the beta zero, I've done this, how do I use you? Where does it fit? And is other people comfortable with fitting you there? And who are you surrounded by? So this quality information, so rather than quantity information, quality information is really important. And I think that's important. So, work and play. So there's a lot of work, but there's a bit of fun involved. I think that's a better learning environment. To get multiple opinions. So to be able to ask people on the table, what are they doing and where are they seeing it? To find peers that are like-minded. They're all really important things. The venue, everything matters, from the start to end. So when I first bought CIE, the lady there, Melda Donnelly, sat me down and said, all right, here's the process from the start of an event to the end of the event. And there was like 720 processes to do one. Right? And she was, her interests, she had attention to detail like I've never seen before. For example, if you're doing we ran slightly different conferences for the institutional market, but if you're doing a conference in Yarra Valley, then make sure someone is there in the morning if you're all having breakfast to check the size of the muffin. If you're trying to build a relationship with someone, you've got a great big muffin, you crack it and it goes everywhere, then suddenly there's a lot more pressure on you, right? Or the size of the apples. Or she had so many rules, so many specific, not rules, but things that she learnt through her journey that she passed on to us. That's really, really important. If you're flying in from another country, then make sure there's a fresh fruit bowl in their room. Make sure that there's mints and water on the tables. Make sure they're comfortable seats. You're expecting someone to stay there for that long. Sit in one room for 8 hours. Make sure there's so much to a really good event, and it's deep. Now we don't have 730 processes. We have a lot, but it's about making sure that everything is perfect, and then when people walk away, they've got relationships, they've got knowledge, they've got something that will really amplify their experience. Now, I want to mention that wealth management and my wealth management business, or our wealth management business, is very much high net worth individuals. Now, we look after everyone, but it's a fee attached, and that fee's got to be appropriate. So why you and I have kind of got a relationship is that there's an enormous amount of people that need to essentially seek better financial outcomes, but they can't necessarily do it through advisors. So how do you get this information? And, what we saw, and I'm really new to podcasts, but, podcasts and video casts and events, they're changing. Where 5 years ago, they were always a sell. If you went to an event, be expected to be sold to from the start to the end. Now there's a lot more people, and you're kind of leading this charge of, hey, I will help you with quality information. I'll help you from not making as many mistakes. And this is a conversation you and I have had before where I always say that most people, it will be okay. They'll be able to retire if they follow the right process. And they don't make any mistakes. And one of the fundamental things that I think I can provide to clients, or I can provide, is don't make mistakes along the way. And then same as your broadcast, what you're doing is trying to help people not make those mistakes. And if you just go through life and you in a very traditional manner, and you find your love, and you buy the house that's the right price, and then you contribute to super, and you send your kids to the right school, and you do all the right things. You don't overgear, you don't get involved in schemes, and you get to 65, you'll live a really comfortable retirement. The problem is who's guiding the majority of people. We wrote a book once that sold a lot, but I really envy what you're doing for the end user, because you're essentially changing their life. And if they avoid the mistakes, then they get to 65 or whenever retirement is these days, 70, in a lot better position. So,
Oh, well, thank you. I appreciate the kind words, mate. Yeah, I do. Because so one of the questions I asked the other night when we were out at it was a jazz bar. Yeah, down here in Melbourne. If you needed a good jazz bar, I know one. We were out, and I asked you. I said, you've done really well for yourself, starting businesses, selling businesses, still owning businesses. Why don't you retire? And not necessarily just go away and just enjoy your money, but the answer that you gave me was really interesting.
Tell me what that was.
Well, we're a few drinks in, but you said that you were so fearful of having to just worry about your investment portfolio, whereas at least while you're working, there's money coming in, and you don't have to worry about what your kids are going to have to worry about in 20 years, because you can solve that problem with money. Do you recall that conversation at all?
No, I totally recall it. I think, this honour of being a financial planner is quite unique, because people come to us at 60 or 65 and they say, here, Jamie or Drew, that, I think is the actual better planner than I am, but they say, this is every cent I've ever earned. And this is I've got inheritance, I've got windfalls, I've got superannuation. This is every dollar. Now I'm 60, 65, it needs to last. I can never top it up. Now that is enormous amount of pressure that I talked about, this emotional state of financial planners, that you go, well, the worst thing is to see a super healthy 65-year-old come in, because they're probably going to live to 40 years, right? Finite pool of capital for 40 years. And you rarely find people where the income that they need from their portfolio isn't directly related to the size of their portfolio. Sometimes you do walk into it, but most of the time the income requirement from their portfolio is substantially more than the portfolio can produce. Yep. So suddenly you're in a position of falling capital. Now, falling capital in falling markets, incredibly scary. Been there before, right? You get drawdowns. You've got to draw down 8%. Portfolio's only producing 4%, and you get some corrections. It's a big obligation. Now, for me, post those businesses, and I spent some time just thinking about life, and I think I love work. I love the ability to engage with people and engage with knowledge, and obviously it has fruits of labour in terms of making money or losing money or whatever. But I think it's that journey that I really enjoy, and the ability to share really good advice and change people's lives by not. And we're not talking about making them millionaires versus not being millionaires, but, guiding people is the addiction. And I think it's the addiction for most financial planners. The ability to go into the room and have the people on the other side be guided by you is an addiction. I think I've learnt so much, and you said before about what did I cope with, that business that didn't go that well on the ASX. I just now think I've got great knowledge, and that knowledge can be shared from businesses like yourself, growing businesses, to people that have a finite pool of capital and they're confused about, how do they manage that, and how much risk to take, and how much should be in cash. And I just feel that if at any point in my career I've got more knowledge now, I've got lots of scars learning all that knowledge, right? But if you think about the things I've done, selling business to multinationals, listing ASX companies, buying and selling businesses, pivoting our business through COVID, then I think that's a unique skill base that I want to share to the right people.
And I think people meeting you know that too, right? That you're focused. I would say meeting you, you gave me a new appreciation for being focused on growth and getting things done, like getting deals done, going out there and just giving it a crack. And I hadn't come across that before. And then that's when we started talking about doing a recording like this, because I was fascinated to get it from your perspective, what it takes to grow businesses, to scale businesses, to sell them, to have things fail, to have things succeed, and everything in between. I just think it's a really interesting journey that you've been on.
Yep. Somewhat stressful, but I've got 3 kids, and you want them to be proud of you, and we've always had really good workplaces. A lot of the people that have worked for me before run their own businesses, which hopefully I've been an influence, and again, paying that mortgage and building a better life for themselves is pretty important, I think. And I am 45, so I see myself halfway through my career. I want to work every last day until I'm 65, and probably started mid-20s. So it's I'll learn a lot more over the next. I think that's important too. This concept that you can always learn more, and then apply it slightly differently. And COVID's taught us all that you can do it differently, and just have a go, I think, is the main bit.
Hopefully, and I suspect they will, a lot of our listeners will get to meet you at our events that we host in the back half of the year. It's looking like there'll be one in Melbourne and Sydney. But I think this was a good introduction to the backstory behind you, Jamie, and the businesses that you've built. There's a lot we haven't covered, and a lot that we can cover in person and when we catch up again, because there's, we can talk about all of those things on the 700-point checklist.
Yeah.
We can talk about how, things can get derailed in financial planning, how you look at funds, how you, scale a business, what you look for in teams. These are all things that you've passed on to me already.
Yeah.
Just walking around the office. So, yeah, I guess this is a fitting way to end it. It's good just to talk to you and to introduce you to the audience before we have those events. And I'm sure you'll be back on the podcast soon.
Yeah, thanks, Owen. A real honour. And my overall passion is still financial planning. So happy to come back and talk about anything at any point. So cool. Thanks, mate.